Kotak Mahindra AMC, joining in on the show right now to talk about what he's making of the markets. Harsha, hi, good morning. Good to have you on the show. Harsha, so much at play. We're on the brink of the earnings season, starting off with IT this week. So many IPOs sucking out liquidity. And then, of course, the tariff overhang remains. Yet, Harsha, the GST rationalization really seems to have given that big fillip to the consumption end. We're seeing that play out in the auto names. Do you think one needs to be overweight autos if one hasn't gone already in their portfolios?
Good morning, Aisha. Yes, clearly, I think this is a big structural reform that we have seen. And most of the consumer durables, including automobiles, will see a structural fillip in terms of demand going forward. We have already seen that in the past 2 weeks or so. Whatever initial numbers and commentary that is coming from automobile sector or from consumer durables clearly indicate that people have kind of started to come back into showrooms and started to purchase some of these. And clearly the demand has moved up. We do believe that it's time to look at increasing your exposure to consumer durables, automobiles, and rest of the consumer discretionary needs. Of course, in the last month or so, some of these stocks have gone up 15-20%. So to that extent, one should not expect a similar up move in the very short term. There could be some consolidation going forward. However, if you are taking 2-3 year kind of a view on this sector, we still believe that there is money to be made.
Okay, Harsha, hi, morning. This is Snehi also joining in. I was just listening to you make your point about how one should be adding exposure to consumer durables. While all of that looks good in light of the GST rate rationalization, on the other side, you also have the entire La Nina phenomenon that could be at play towards Q4. And that could once again bring in, a dampener in terms of monsoons, like we saw for some of these names when the monsoons came early this year. How does one factor in this? What kind of weightage should you give these factors in your mind when you are playing this entire consumer durables theme?
Snake, clearly, this is not a call on the very short-term outlook, as we spoke earlier as well. Some of these stocks have seen a good run-up in the recent times, and the demand is just at this point of time improving a bit. So I don't think the earnings are going to see such a huge bump up immediately. However, this is a structural reform in our mind and will continue to improve overall demand for these products going forward as well. As far as the expectations of a La Nina next year, if that were to happen, I don't think it's going to have a similarly negative impact as it would have had in a usual year, given the fact that this year and previous year we have seen very good monsoon. And when you look at 2 good years of monsoon and reservoir levels reaching almost like 126% of the 10-year average, etc., it's very unlikely to have a big impact on the rural economy, even if it were to be a weak monsoon. However, yes, sentimentally it could have some impact, but that is still some time away. And when you are taking a call for next 3-5 years, there will be several quarters, several periods where probably the demand is not going to be as strong as one would expect. So that's part of the game. However, from a medium to long term, I think it still makes sense to look at some of these sectors on a selective basis.
Harsha, hi, this is Harsha. I want to get your sense in terms of your portfolio allocation. Bank seems to be the largest play at this point, and this is across even within your large cap basket, even within your flexi cap basket. I see a lot of banks there. Trying to understand, we've been through a long, difficult period of consolidation of sorts, at least in terms of what you are holding. What's the sense like? What are the triggers likely to be, and what's causing you to be bullish with regard to banks?
First, clearly, I think we have seen a very good consolidation in terms of most of the large banks and even NBFCs to some extent over the last several years. The valuations are no longer at high levels compared to market. They are at reasonable levels. We have seen NIM impact coming into the most of these banks in the last few months, given the fact that there were repo rate cuts. Most of that is also already in the price. The asset quality issue is very benign. We are not seeing system-wide issues in any of the segments at all. There could be some issues in specific names, specific segments, specific regions, but otherwise, at the system level, we are not seeing any of the asset quality issues. And we do hope that we are likely to see credit growth inching up in the next few quarters on a sequential basis and gradually improve thereafter as well. So overall, this seems to be one of those segments where probably most of the negatives we have already seen and valuations have kind of discounted all of that. And from here on, probably there will be gradual recovery in terms of credit growth and asset quality should hold up. And that's where we believe that it can possibly outperform the market.
Got it. And your take on IT, because I saw a couple of IT names there as well. Is that just the contra play, or are you bullishly constructive even with regard to the fundamentals, the underlying growth, etc., versus the valuations that they're trading at?
Most of our portfolios innovate exposure to IT, and we do have concerns in terms of the business momentum, which seems to have clearly slowed down in the recent times. There are various other business headwinds as well at this point of time. It's unlikely to grow at a pace which is more than the average earnings growth for the market itself. So to that extent, we continue to have underweight exposure on this basket. However, selectively, some of the names may offer comfort in terms of valuations, in terms of some of the business parameters, etc. That's where we do have some exposure.
Right. Harsha, the latest one on the bandwagon, though, seems to be the hospitals from the healthcare universe. Of course, most of these stocks have done very well, and we know as India's demographics from a younger population ages, we know the scarcity premium that one can assign to some of these listed plays. But do you think now they really become part of your core portfolio, and that's the view?
They're already part of our portfolio, so clearly the long-term demand drivers continue to be very strong. However, we are unlikely to add further positions into these names at these valuations. While we'll continue to hold down and monitor how it moves, but if there were any significant drawdowns in any of the names without any much of change to overall fundamentals, then we would probably look at adding some of those names. However, at these valuations, we would like to just hold on to our existing positions rather than incrementally buy some of these names.
And Harsha, with regard to flows, right? That's and I'll zoom out, talk more with regard to flows, etc. That's one problem area, if I can call it, as to why Indian markets aren't showing the kind of zing that they ought to have. Especially given domestic flows have so much strength, do you expect foreign investors to start to reverse at some point of time over the next 3 months? Give us your take.
Sure. While I agree that it's one of the issues, I don't think it's the only issue. I mean, we have seen earnings clearly decelerating over the last 12 months or so and continue to be quite muted compared to how corporate earnings growth moved between 2020 and 24. So to that extent, there are fundamental reasons as well for markets to remain sideways or lackluster in that sense. Along with that, yes, foreign flows have been negative for the past 12 months. Even year to date, we have seen negative flows. And even in case of last 3 months, where most emerging markets, with the exception of India, have seen inflows as people seem to be moving out of US assets, US dollar-based assets, etc. We have not seen those kind of flows into Indian market. The only reason I can think of is probably the way the trade negotiations have gone between India and US is probably completely in contrast to what was expected at earlier times. So to that extent, probably even when the flows have resumed for emerging markets, the foreign investors may not be still comfortable looking at India, given how some of these tariff negotiations have gone through in the recent times. But we do believe that the overall valuation premium that India generally used to get over emerging markets has come off quite meaningfully. So to that extent, once the sentiment improves, we can definitely expect flows to come back.
Okay, so well, all eyes are going to be on when that sentiment improves. But Harsha, really appreciate you joining us and sharing your view about the markets with us. Thanks so much for your time.
Thanks.
Okay, and let's take the conversation.